Traders, welcome out to your trading room as we prepare for the week ahead, September 9th through the 13th, coming right up. Corey here with you. Certainly the B team. I'm probably the C team. I guess Rob, Joe, they would be the A team, B team, and I'm way down the line. But we're going to have a lot of fun. Let's jump in and take a look at markets together. So we always want to explore what's been happening in the markets and how things are rotating. And you're going to see based on this week, it was an ugly week and some real changes in the market. And that's going to lead us to our setups, which are going to be focused in one direction and one direction only for this week upcoming.
Disclaimer. This video was created for professional stock and option traders. Maverick Trading is a proprietary trading firm that employs professional traders around the world. Our traders trade firm capital and keep 70 to 80% of profits they generate. All trades and analysis in this video are for professional traders only. If you are interested in becoming a professional trader for Maverick, click the apply button in the video description. Let's get ready for the week.
So as we get prepared for the week upcoming, we need to look in the rearview mirror and see what happened this past week. And let me tell you, it was ugly. The double top in the markets is now starting to confirm a little bit because we didn't hold at the short-term moving averages. And I'm going to really spend some time on the SPX chart and tell you why I think that's a problem. The Qs continue to lag, and of course we know how big the Qs are as a percentage of the S&P. That small group, the Magnificent Seven, whatever you want to call them, those stocks have such a big impact on where the broader markets go. Volatility is on the rise again. VIX has spiked back up into the 20s. And look, a couple of Mondays ago, we had a really ugly day, but the week was fine. We rebounded back. It was kind of a non-event by the end of the week. This week, it was the worst week of the year for 2024. Seasonality is bearish, and we finished dang near on the lows, so not great price action at all. It was really triggered further. I mean, we had some bad data to start the week. We had ISM manufacturing data, which came in below 50 back on Tuesday. And the problem there is, of course, that shows a contraction. That anything above 50 is a growing market. Anything below 50 is basically like a recessionary, a slowing, a retracing market. We saw ADP employment disappoint, and then we saw non-farm payrolls disappoint on Friday to finish off the week. 142,000 jobs, whereas 164,000 had been expected. As the job market goes, so goes the stock market. There's some really interesting data where you can overlay and just look at jobs and say, okay, are stocks going up? Well, when the unemployment rate is going down, meaning more and more people are getting jobs, the stock market tends to go up. When the unemployment rate starts to turn up, the stock market starts to turn down, and the unemployment rate spiking above 4% has historically been a pretty bad time. There's some fundamental indicators, the SOM data and so forth, where when you spike above 4, that's like a big canary in the coal mine that's basically whistling at you and saying, hey, something is wrong. We're seeing jobs going the wrong way. And look, if people are losing their jobs, they're going to spend less. And we know this economy is based on consumer spending. So all of these things have a role. Now, does all that fundamental impact where the market goes over the next week or two? No, but we want to pay attention to the big trends and the big situation of the economy long term. Here you can see the weekly performance, just dreadful. Dow down 3, S&P down 4, NASDAQ and Russell 2000 down 5, oil absolutely hammered, down 7% on the week. Gold relatively strong because it was flat, and gold is of course the most defensive of all of those, the least tied to the economy, the least cyclical and so forth. So not great price action, my friends. Now as we take a closer look at the S&P 500, I was on record as saying, look, we're probably going to back off. When price action goes up to a key level from the past, it responds to that. And usually you'll respond. I always tell people when looking at technicals, you either stop short of the major resistance or you just pierce your head through. But either way, big picture, you respond. So this one stopped just shy, but that's fine. That's still a retest. I always say to draw these like they're a big crayon, just a big zone, not an exact number. So we retested resistance. Okay, great. Do you normally form a huge double top? In other words, is this a big peak here and then you go back up and you fail and here? No, most of the time you're not in a double top. You're not in a big double bottom. Most of the time what happens is you cup and handle, or you do some sort of ascending triangle, some sort of continuation pattern. So not surprising at all that we respond to resistance and we back away. And I thought this 5,500 level was key, because if you do the math on a cup and handle, basically if you measure the size of this big cup, the handle should be about 30% of that, and that put us right at about 5,500. So this 5,500 level was right at those moving averages, right at the 50-day. It's perfect, right? That's the make or break zone. If it's a cup and handle, you'd stabilize here in that 30% of the cup area, bounce, head back up to resistance a third time, and away we go. If you fail at this level, which is exactly how we finished the week, that is a failure, that is a breakdown. The probability of this being a huge double top and so on really has increased. Now, the bulls might continue to grasp at things and say, well, but maybe it'll turn into an ascending triangle, or maybe it'll just remain choppy. Well, there's lots of maybes, but I just don't see it. In terms of the price action, for me, it was simple. If it cup and handles, it's great. It looks fantastic. You want to be bullish, etc. If it doesn't hold right here, I don't really want anything to do with it in terms of betting big that it's going to go back up, or holding out hope and remaining bullish. It just doesn't make sense to me. Could it go into a big consolidation? Sure, right? But that's almost best case scenario. Best case scenario for the bulls is that it chops around here for a little while, works off a lot of this, and then proceeds to go up somewhere in the weeks ahead. I just don't see the bullish thesis holding on as much as it could have, would have, should have. Well, it didn't, right? If we look at the equal weight S&P, look at where we had broken out from. You'd like to see it come back and kiss that level, and the old kiss goodbye, come back to the old resistance. The old ceiling becomes the new floor. That did not hold, my friends. The equal weights. So it's not just a large cap tech. It's not just the Qs that are dragging everything down. Look, everything sold off this week. If we look at the Qs, we know it's worse than everything else. You failed to even get back to the prior highs. Now you're heading towards the lower end of the range. Again, best case, this turns into some sort of symmetrical triangle. Worst case, we're heading that way. So the way I look at it is, maybe you're sideways, you're more likely to be bearish, but it's in that category of 0 to -1. That's kind of zero's best case scenario for the markets right here, right now. So we did not hold at the key levels. Watch for some consolidations. I mean, anytime you go down 7% last week in the NASDAQ 100, there might be a bounce back of 1% or 2%, but that's a consolidation. The most common candlestick after you have a big candle is a little inside candle. So will we bounce at some point this week a little bit? Sure, probably so, right? There's usually some overlap. If this is last week's candle, you might get a little overlap here, but ultimately, the candles that are most likely to form over the next couple of weeks are still going to be pointed more down than up. We've got CPI out on Wednesday. We know the Fed is watching inflation. The Fed meeting is September 18th, so 2 weeks away. This is the CPI data prior to that Fed meeting. We just saw the jobs number come in worse than expected. They really have cover that we know they're going to cut rates. They have the data, they have the cover, market participants are expecting it. Now the question is just, do they cut by 25 or 50 basis points? One could argue that a 50 basis point cut would actually be worse, just given that it would show that they're a little more concerned and a little more worried about the economy. So we'll see. This is seasonally a very bearish period, but we've got that CPI data on Wednesday. We've got the ECB out with their statement, and they're expected to cut rates pretty dramatically from 4.25 to 3.65. And then we finish it off with some PPI data, not watched as closely as CPI, but certainly of note. Now, monthly outlook has turned bearish, right? We're not really in a strong downtrend. We don't have sloping lower moving averages or anything, but we did break below the 20. We broke below the 50. We're not holding where we would have, could have, should have. That's a problem for the markets. Do I expect a little back and fill? Again, when you have the worst week on record, you're probable to bounce a little and have an inside type of week, a little bounce back, kind of a sideways type of week. But the risk is that you back up down 7% in the Qs with another that's down 9%. And I can't say that that's not possible. When you start to see these types of red bearish candlesticks, you can throw out some weird numbers and they may come true, right? When you see big red candlesticks starting to form, look, things tend to get worse before they get better, right? And so if you saw this big red candle and you said, well, we're going to be down, 7% over the next 2 days, people would be like, what, Nostradamus, you think you can predict that? But look, bearish things happen when bearish markets are hitting. All sorts of things can occur. We don't know how heavily leveraged people are on the long side, how bulled up and margined up they are in the Apples, Amazon, Googles, Nvidias of the world. So just be of mind that it is a little higher risk when you start to see that type of bearishness. Anytime you're trading below those moving averages, the risk to downside just increases. So for the week, we had one sector very, very, very slightly higher. Real estate eked out a tiny little bit of a gain for the week. Everything else bludgeoned. Tech down 7, energy down 5, materials down 4, industrials down 4, communication services down 4, etc. So let's go do some work on these sectors and say, okay, we can see bad price action there, but what does that do to the charts? Well, XLU is one of the best, right? It's still above a 20, still above a 50, still upward sloping. Look, it's going down the last couple of days, but still holding up better than most. So technically, there's still better support for that sector. Communication services experienced a rough week like everything else. One could argue that you're in a big trading range. Upper end of the range was stalled out at now for the third time, right? So up here, you really have multiple touches to that resistance. The support would be down here, and we look like we're headed that way. We've got this at a -1. Again, you don't have the moving averages in proper order. The 20s above the 50, they're sloping sideways. So it's not a runaway bear market. It's more sideways to mildly bearish. Real estate, still pretty strong, and again, up on the week. So you got to give credit where credit's due. How in the world did this hold up and stay up on the week when everything else is going down? Look, there's some underlying demand for that. Still upward trending overall. Healthcare gave back some ground, but better than most. A +1. Just closed just below the 20, but those moving averages are still upward sloping. Still decent price action, all things considered. Industrials, well, we didn't hold where we could have. Maybe one would argue where we should have if we were bullish, right? We tried to. Old ceiling, tried to act as new floor, didn't hold, and away we go to the downside. So having said that, you still got to give some credit. I mean, we're above the 50, and these are upward sloping. You're below the 20, so you've got the bullish slope in both of those, but bearish here, bullish here. I think we come back to, well, just a mild +1. In danger of not holding that either, but industrials look better again than most things. Financials definitely look better than most. Still above the 20, still above the 50, still above the breakout zone. If you got to look for something bullish over the next week or two, you want to add something as per your plan, the financial sector is not a bad place to look. So that's still relatively healthy. Consumer, well, tight basing pattern, broken on Friday to the downside, just closed below those moving averages. I mean, I gave this a 0. I mean, it's just right there, still in this tight range. Did start to break down. I could understand if someone wants to give it kind of a -1. I don't think you'd be too bearish on it. It's really choppy and sideways, but maybe just in that category. Technology, definitely bearish. Below the 20, below the 50, you're going to start to see the 20 slope down at a faster pace. The 50 still has a little bit of downward slope to it, and they're in proper order. 20's below the 50. That 20 is going to play catch up here within the next couple of days. So again, you may get some back and fill, but ultimately probably headed back towards those lows is how it looks in tech land. Materials, more bearish than bullish, right? Below the 50, below the 20, but those moving averages are on the other side, so I gave this a 0 as well. It's just a mixed market, just a sideways, more likely to consolidate than anything else. And last but not least, energy. Well, when oil's down 7%, you're probably not shocked to find out that energy had a rough week, all the way back to the lows. And if you were to look at all of these sectors, which one is all the way back to that couple of Mondays ago low? The energy sector is. So certainly quite bearish there in the energy sector. So here's how we stacked them up. Tech and energy looked the worst. Communication services just behind. Materials and consumer more on the sideways. If you want bulls, there are some sectors holding up relatively well. Utilities, real estate, and financials doing the best. Now, this brings us to our trade slots. We lost 4 trades this week. We had two in the +1 camp that rolled off. We had a neutral, and we had a +2. With that, that leaves us with the black that you can see here, right? We've got a 0, we've got a -2. We've got a couple of +2s, we've got a couple of +1s, and we got one +3. Well, we know we need to add some bears. We're now below the 20, we're below the 50. The slope's still backwards and still sideways, but we're leaning a little bit mildly bearish. Is it time to get massively bearish? No, but we can see that this week was a bad week for markets and it really changed some things. So with a market outlook that has flipped and has turned, we're more in this category of -1. And a -1 says, well, we need this grouping. This is how many trades we need in each slot. We need 1 of these, 3 of these, 4 of these, 5 of these, and 2 of these. We need to be focused a little bit more on the bearish side. So I'm going to work on that in terms of adding some to that section where we're lacking, right? That's really our outlook. We need to add some bears given where we're positioned right now. So what I'm looking to do is add 3, because we have 0 right now, -1s with what's rolled off. We're going to add 3 new -1s and 1 -2. Now that will leave us, you can see, whoops, I didn't circle that very well. We'll have 5 on the bullish side. We will have 5 on the bearish side and 1 neutral. That'll get us a little more aligned, not perfect to what we want, but certainly will get us more aligned with our outlook. So possible trades. Here's what we were looking at. We're going to start with the consumer sector. Amazon is in that sector. Amazon has rolled over again just below the 20. You can see if you were to drag down trend lines and such, basically it rebounded up to this level, never crossed above those moving averages, so relatively weak compared to broader markets, right? The S&P moved above those moving averages. Amazon could never do that. We're looking at a September 20th $2.50 wide spread. So even though Amazon is a super expensive stock, its options are nice and liquid. You can trade a $2.50 spread and have a pretty good risk to reward. If it finishes below 170, max gain. If it's above 172.50, max loss. It's a tight spread, but it's a good little risk to reward probability play. I think more likely to finish below 170 than up above those levels over the next couple of weeks. So Amazon on the list as a bearish candidate, simple bear put spread. Now, could you widen out those strikes? Could you do something where it was like a 175, 165 or something like that? You could. It depends on how big you want your position size to be, how much capital outlay to go with right from the start, and so on. We kept it simple. Nice little $2.50 spread. You're probably paying in the neighborhood of about $1.10 for that in terms of a debit, and that would leave you with about $1.40 of max reward. And so 110 at risk, 140 of max reward with a spread that's just kind of right there around current stock prices. That's pretty good in terms of getting more reward than risk. Again, we think it's better than 50-50 type of proposition. Next, we're going to add in the tech space, another one of the large cap tech. Here's Microsoft. You might note bearish engulfing candle on Friday actually engulfed and swallowed up the prior 2 days bullish bodies. So bearish spread. Here we're looking to go a little bit more bearish. This is a -2. So I went out of the money on both strikes. 397.50, 392.50 bear put spread. What that'll do is give you even better, probably in the neighborhood of $2-ish debit. $3 then would be your max reward, and hopefully we can pay less than 2, but even if you pay 2.10, somewhere in that neighborhood, it's about $2 at risk, $3 of reward. Now, better risk to reward because we're out of the money on both strikes. And as we look at this spread, max gain if it's below 392.50 in a couple of weeks, certainly not, a given, but I think this stock is headed back towards those lows. May get a little choppy. Hopefully on Monday there's a little gap higher or something to where you can put the spread on at a little bit better price, but nevertheless, again, we like that structure, and that one's a little more bearish. Again, going out of the money on both strikes increases your risk to reward ratio, but lowers your probability of success. Next, we're looking in the materials sector, and here you've got Mosaic, fertilizer type name. Mosaic has been in a descending triangle, broken that level and confirmed that on Friday. Here you could just do a simple 25-24 bear put spread. That's a -1 trade. It's not targeting a massive amount lower. If we finish below 24, max gain. If you finish above 25 at expiration, max loss. And we think that's a good structure for just this continuation. Where is this stock likely to move lower? Yeah, more likely to go lower than higher here in the near term. Last but not least, the energy sector and Chevron. Not great price action. Again, just think about how bad this is lagging compared to broader markets. Never able to get above the 50. A little bit of a rebound here, but ultimately we've taken out the lows from a couple of weeks ago. Confirmed bearish breakdown. Here you can just buy the 140 put, sell the 135 put, max gain if we're below 135, max losses above 140. Just a simple bearish outlook, -1 type of structure. And again, there you might get Hopefully a $2 risk, $3 max reward, somewhere in that neighborhood would be ideal. Again, the best case scenario for all of these would be a little bit of a gap up, just so that you get a little bit better pricing on Monday morning. Now, in conclusion, we've got the Fed meeting coming up in a couple of weeks. Rate cuts will begin, and historically speaking, they cut rates because things have started to go wrong within the jobs numbers, etc. And that's what we're seeing here. I'm not saying we're full blown recession, but we are starting to see that unemployment rate ticking up now for multiple months in a row. September to October are bearish seasonally, and this year, I mean, it seems to be playing out. Not a guarantee that it continues, but historically, if you could stay out of that September to October period, you'd do much better. That's where that whole sell in May, go away, sell in May and then you come back around Halloween, because historically, from about Halloween through May is the good time for markets. And certainly September and October have been historically when most collapses, catastrophes, things of that sort have happened for one reason or another. I don't know how to explain it other than just a bearish seasonal period typically for stocks. Hope you enjoyed the trading room this week. Have a great week coming up, everyone. We'll see you next time.